Hello, everyone, and welcome to today's event to celebrate the publication of Raising the Bar. My name is Sarah Gelfand, and I'm a Managing Director at BlueMark, and I'm delighted to be here today moderating today's discussion. Before we get started, just a couple of housekeeping items. First, we'll plan to reserve the last 15 minutes of this session for Q&A. So if you have questions, feel free to submit them using the Q&A function at the bottom of your screen. Second, if you're looking for a copy of the Raising the Bar report, we are going to put the link in the chat so you can have it. And third, and finally, I'm really grateful and honored to be joined today by a terrific group of co-panelists, including Fran Seegull, President of the U.S. Impact Investing Alliance and Executive Director of the Tipping Point Fund on Impact Investing, Elizabeth Seeger, Managing Director of Sustainable Investing at KKR, Tommy Pashton, Head of ESG and Impact at Vital Capital, and Bhavika Vyas, Managing Director at Stepstone Group. And I just want to offer a special thank you to the Rockefeller Foundation and the Tipping Point Fund on Impact Investing, who provided the grant funding to BlueMark that allowed us to conduct this research. So I'm going to take the first few minutes of today's session to share some of the high-level findings of our Raising the Bar report and to set the stage for this conversation. And then I'll shortly move to engaging and inviting feedback from my co-panelists. Just to start and to clarify, the scope of our research was really focused on impact performance reporting by private market fund managers to their investors about their impact performance and impact results. And we had a few questions about this kind of reporting. One, what is the current state of this impact reporting? How are GPs or fund managers reporting to their investors on their impact performance? Two, what does the market think best practices for this kind of impact reporting are? And three, what are some pathways that the market thinks it's ready and willing to embrace to improve the quality and usability of impact reports going forward? So our approach to answering these questions was twofold. First, we analyzed about 31 impact reports prepared by private market fund managers, and they were all published in the past 2 years. And second, we interviewed, both through one-on-one dialogue and through focus groups, 57 different industry stakeholders. And we talked to fund managers, asset owners, academics, standard setters, and a range of other kind of industry practitioners to try to understand their views on those three questions I laid out just a moment ago. So I'm going to start to share kind of a few key findings. First, as it relates to the current state of impact investing, I expect many of you on this webinar know that impact reporting has the potential to play a really critical role in deepening our understanding of impact performance, both at the individual fund level as well as field-wide. It's also a means to hold investors accountable to their claims, to drive more effective capital decisions, and generally to increase transparency in our market. And at the same time, there's also widespread recognition that our market today is currently quite limited in its ability to use impact reports to their full potential. So a few notable themes from our research. First, impact reports tend to talk about impact objectives, but they vary considerably in their specificity, making it really challenging for readers to understand what the results that were sought or expected actually were. So 87% of the reports we looked at included some description of the fund's impact objectives, but only roughly a third specified quantified targets. Second, reported impact results are often cherry-picked. In the reports we looked at, about a third included information about all investments in the portfolio, and the other 2/3 only for a sample. And so this cherry picking fuels this sense that reports are only showcasing the best performers and raising questions about the nature of the other parts of the portfolio that aren't shown. Third, impact reports are rarely forthcoming about risks or failures. Only about 40% of the reports we looked at had any commentary on impact risks, and 0% talked about or included any quantified negative impacts. And I should clarify, while risks are hard to share in public-facing reports, our analysis included a mix of reports prepared by fund managers and delivered just in sort of directly to their investors and were private, as well as reports that were public. So including in those reports that were shared from a fund manager to their investor, there was zero quantification of negative impacts. Finally, reports often miss the stakeholder perspective. That lack of a view into the experiences of those affected by investments is problematic, and really fewer than half of the reports we looked at attempted to include case studies or shared any direct perspectives from stakeholders. So in addition to trying to quantify kind of the current state, we really wanted to understand some of the underlying market dynamics that are driving these kind of trends in reports. And here I also want to highlight 4 things. First, fund managers are overwhelmed by inconsistent and contradictory information requests. This is, I think, the result of both the proliferation of a number of new standards for investors, as well as different kinds of requests from their limited partners asking for information in bespoke ways. And so that overwhelming kind of bespoke reporting makes it hard for them to adopt any common approach. And the result for asset owners trying to consume these reports is that it's nearly impossible to compare information from one report to the next. Second, when sort of trying to get under the hood of what the primary motivation or use case for impact reports is, we heard loud and clear that most of the time these reports are really for fundraising and marketing purposes. And so in that way, many managers feel that their investors want to see vanity metrics, success stories, and the work is more performative. And the flip of that is investors feel like they've seen a cherry-picked set of examples and data, and it's a missed opportunity on both sides for really deeper or richer discussion. The third point I want to make also came out in conversations we heard with standard setters and others, and that's the sense that the field has really overemphasized standardized metrics and quantitative precision at the expense of focusing on how to convey contextual information that allows a sort of deeper understanding of the nuances of the impact being pursued. Of course, this was also discussed when recognizing there's a real tension between accessible, simple, quantified reports versus more nuanced reporting that focuses on strategy, context, and learning. And the last point I'll make here is that we've sort of settled into this negative equilibrium, as one of our interviewees shared. And this kind of dynamic we're in where very few actors know how to be a first mover to generate and to prepare reports with increased transparency is a big sticking point for the field. But I want to move beyond kind of the problems and just take us to the next slide, which is, despite this, we have really encouraging findings coming out of this research, and that's that there was really broad consensus or agreement in the market about what a good report includes. And so we asked everybody we interviewed what they thought were key to a quality impact report, and there was a tremendous amount of alignment in how folks answered that question. And so we in this research attempted to bring together those points of consensus, and that's the framework on this slide here. Basically, we kind of structured this into 2 parts: overarching concepts that apply across an impact report, and those are concepts of completeness, meaning the full balance of information needed to understand impact results and risks is present, and clarity, the information is digestible and lends itself to interpretation. And then there were 5 specific elements that came out of our research. And these 5 kind of pillars of a good report are here in this slide, and then also expanded on in more depth in the research paper. And we hope provide a starting point and a bit of a checklist for folks as they think about their own reporting. But in summary, they are well-defined objectives and expectation. That's meaning that it's clear what the fund's intent and goals were and what the expected results are. 2, that the metrics are relevant, they're standardized wherever possible and linked back to the articulated goals. 3, that the performance results are presented in a way that allows the reader to effectively interpret and contextualize progress and performance. That could be relative to targets, prior results, and ideally, where possible, external benchmarks. 4, that there's a view of stakeholders, that a quality impact report identifies affected stakeholders, incorporates their experiences and voices to the extent possible. And 5th, and finally, that there's transparency about risks and lessons learned. So these elements, I think, as I mentioned, came through in the conversations with all of our interviewees, but they're also aligned with many impact management best practices and have corollaries in the concepts for quality financial reporting. And so they are a starting point, but we're really excited about them as a real promising starting point for the field to really understand what it could mean to step up the quality of reporting in our market. So finally, I just want to talk about the last question we asked the market, which is how might we move the field towards better reporting? What stones need to be laid to pave the path? And I won't walk through this entire grid here today, but we do recognize both that multiple actors have a role to play: consumers of reports, producers of reports, and standard setters and others who help the industry understand how to frame reports. And that additionally, different market actors are at different stages of maturity in their own work. And so some may be more in a position to lay the groundwork or prepare for better reporting. Some may be ready to promote or start implementing best practices. And third, are leading the market forward as pioneers. And so we put this to the field, recognizing that all of us, if we care about strengthening the quality of our understanding of impact performance, have a role to play. And excitingly, I want to end my comments with 2 really great announcements. First is that we've launched a pilot just last week with a Impact Frontiers cohort. We are working with a handful of Impact Frontiers members to both test the presence and applicability of these key elements in their reports, and to pilot a verification method that allows us to provide a bit of a third-party view into the appropriateness and quality of their use of these elements and the quality of the data as well. We are excitingly planning to publish the findings of that pilot later this year and look forward to sharing those with you. Second, we published today a joint statement from a group of 7 leading asset owners documenting their shared commitment to building the impact investing field by encouraging their fund managers to adopt the key elements I just walked through. And I want to give a big and special shout out to Bank of America, Big Society Capital, Bright Light, Caprock, Hall Capital, Jordan Park, and the Stepstone Group for their remarkable leadership and use of their influence to help move our market along. BlueMark, we're happy to talk to any fund manager or asset owner who's interested in learning more about either of these initiatives in the weeks to come. But for now, I'm excited to turn the stage to my co-panelists and really hear from them about how these findings resonate with their own experiences. So I'd like to turn the table now to Elizabeth and Tammy. And Elizabeth, maybe I'll start with you. Reflecting on what we heard in this report, I'd really be interested to hear what are some of the challenges you've experienced in preparing reports for your investors, and maybe a bright spot in the evolution of your reporting.
Yeah, sure. And first of all, I want to congratulate you on what I think is a really great report that cuts through a lot of the noise and I think a lot of the conventional wisdom that we see in the impact space and as it relates to reporting and metrics. So really enjoyed reading it and appreciate the key findings, and I'm excited about the next steps, so appreciate that as well. Also want to just add, I wear a number of hats at KKR as it relates to what I'm going to say. It's the hat related to KKR's Global Impact Fund strategy, which is a private equity strategy investing in companies where the core product or service is helping provide a solution to one or more environmental or social challenges aligned with the SDGs, so not the ESG side of the work that I do at KKR. I would say certainly a lot of challenges we all face as it comes to impact reporting, but one of the ones that I saw reflected in many comments in the report that you just described is this question of like audiences and the challenge of speaking to all of the different audiences and the audience needs that are different across the board. So you have some audiences, for example, the range being all the way from somebody who's never heard of the strategy, maybe an impact skeptic, certainly doesn't have a point of view on what impact means, all the way to another type of audience that really just wants the raw data so that they can analyze it and present it in a way that's relevant for their own particular stakeholders. And it's my view that if you optimize to one of these audiences, you're inevitably going to leave another audience behind, right? So how do you balance those in a way that doesn't result in throwing everything together into in the kitchen sink or whatever the case is, and ending up with something that is not meaningless, but is also being responsive to those different audience needs. In terms of a bright spot, I think just sort of on that theme, back in after we completed our LP facing report in 2019, so we have a fund investor facing report and then a public version as well. The public version is a subset of the LP facing one. We spent a lot of time actually interviewing the fund investors to help us understand what did they think was interesting, important, missing as it relates to the first report. The good news is I think a lot of those things were reflected in your report, so hopefully other people don't have to go through that same journey that we did. And also the good news is that we were able to improve our next report based on that input. And I thought that was a really valuable exercise. And one example of something that we added in our following report that hadn't been in our earlier one is that discussion about impact risks and impact challenges, which ended up being, though a short part of our very long report, one of my most interesting parts of the report. And I think that it's important for us to continue to forward the dialogue in the impact space, is to acknowledge the really hard aspects of what we're all trying to do here.
Well, thank you for that, Elizabeth. I think that challenge of speaking to multiple audiences is real, and one that we heard from others too. And kudos to you guys for being transparent about risks as well. Tammy, how about you? Could you share a little bit about your experiences?
Of course. Thanks, Sarah. And I also wanted to thank you for inviting me today to participate on this panel. We're thrilled to have research like Raising the Bar, since it provides fund managers like ours practical guidance for the preparation of our impact reports, and we're actually in the thick of it these days, as I assume many of us on the call today are. So that's really great and very timely release of your research. So to go back to the question at hand, on challenges and bright spots. So I'll focus on where we stand as a fund manager taking an active role in growth markets, and also in the context of today's panel, being a smaller fund manager amongst these guys. So first of all, on the growth markets angle, it's focused on getting good verifiable outcomes level metrics for our reports. So it's maybe one step back still. We build in remote places. So we build a dairy processing plant in Western Uganda and a housing company building in rural Angola. And some company managers are brilliant with impact data, and others are clearly not impact practitioners. So I work very closely with our companies on education and training on what is impact, why we are measuring this, because if you want to collect meaningful outcome level data, and not just outputs, we have to work together with the company to identify how to do this. And the how sometimes is the trickier side. A bright spot here is the additional contribution. So it's getting the CEO of the dairy plant to realize why I want to know how many female smallholder farmers he's buying milk from, right? But now to the second part of putting this into our reports for LPs as a smaller fund manager. With the evolving levels of sophistication, we need to be practical and efficient in producing our reports. So one thing that we've been working on is redesigning our backend, so the hardware of our impact reports. We're developing dashboards with indicators that are linked to reference frameworks, so that once we do get the verifiably good data, we can seamlessly measure and benchmark and spend most of our time and effort on analysis and management to drive impact value creation. So that's what we want to be reflecting more of in our reports, and not just on the numbers. So more on the narrative and what we're actually utilizing those numbers to do. So it's a lot about efficiency for us right now.
That was super helpful. And I think your points about, well, just the challenge and realities of trying to get detailed and rich, accurate data from portfolio companies on the ground is one that many struggle with. And then great to hear you're investing in data management systems because, yes, so much of this reporting is predicated on having information accessible and in a centralized place. Well, Bhavika, I'd love to switch to you now. And I mean, at Stepstone Group, being on the receiving end of a lot of impact reports, I'd love to hear a little bit about the challenges you've experienced trying to consume and interpret these reports, and maybe a bright spot from you too.
No, happy to, and thanks for having me. I would say that the bright spot is for me this conversation, because I agree it needs to happen, and we are seeing, other factors driving increased disclosure, whether it's regulation in Europe or new regulation that's rolling out that's similar in other jurisdictions. And I think having this conversation between LPs and GPs is more helpful to get ahead of that a little bit than having it defined by other groups that may be even less close to the issues that we're experiencing. So I think it's a productive thing for us to all have jointly. On the challenges, I would echo what's already been said, and I think for us it even goes to another level, which is that we work with a lot of different institutional and high net worth clients globally. So even as you're seeing different demands from your clients, we're also seeing that at another level of scale, right? So we're seeing a lot of regional differences between clients in, say, Asia or Europe in terms of how they understand what is impact, how they conceptualize it. And sometimes these reporting things are actually gating items for them around, can they even add impact to their portfolio, because they need to be able to simplify it into, some LPs have said, like one metric. And that's really, really hard to do, as we can all appreciate, right? Because impact is a complex animal. And then we're trying to, provide reporting that's aggregated up from multiple GPs and multiple funds that one of the things we offer our clients is that diversification. And one of the challenges we face is that with all of the best intentions and everybody trying to be as transparent as possible, we're still getting reporting that's in very different formats, that's on very different bases, and we're trying to offer a consistent picture across funds, which is hard for us to do. And I think that's what leads us into wanting to have the conversation around numbers as well as the qualitative information, because the numbers are something where we can see more consistency across funds, because that's one of the challenges for us, is that we're not just investing in KKR or just Tamar's fund, we're investing across a portfolio and trying to give a whole scale picture to our clients. I think so for me personally, establishing the metrics upfront, I think, can be helpful to GPs. So understanding these are the themes you invest in. One of the other things I would note for us is we define impact more broadly than just funds that self-identify as impact. So we're also talking to managers that are within impact themes. And that's also where we've seen that we have to work with them around impact metrics and reporting, because they didn't come to it from an impact sort of history. And may not be as sophisticated on that side, and it may not be a big part of their own client base in terms of who's asking for this, right? So we try to engage early on to say, based on the themes you're investing in, these are the metrics that we think are relevant for you. Hopefully they're aligned with your business objectives, so they're not just random things to measure, but hopefully should be in achieving that impact. As you scale, you should see growing impact. We can work with managers to set up formats that work for us in terms of our reporting. And hopefully, as we create that consistency within the theme, that in itself is hopefully useful for managers as they're having other client conversations, as these are the 3 or 4 impact metrics that we think are most relevant for our themes. I think the glossy reports and things are great. In some ways, though, we're happy to not have, you spend money on that or your time on that. We're happy to just have the data and the conversation, because we can feed that into our own reporting as need be. So for us, it's about being flexible and having those conversations early so that we can all be aligned. And we realize the challenges that, different types of GPs face, large GPs that might be investing across a lot of different themes or asset classes versus even smaller, more specialized GPs that are deep, but maybe in, as Tamar described, in more remote geographic areas. And so appreciate all of those challenges and, trying to do our best to have that conversation early and create formats that are consistent.
Gosh, there was so much in what you said. I mean, I do want to note, we definitely saw the challenge of reporting in a coherent way across diversified strategies, and that point really resonates. Additionally, I think when you talked about just your diversity of stakeholders and how hard it can be to bring sophisticated impact concepts to folks who have an appetite for one metric, or who are just not sort of living in this world quite as much as we are. So I appreciate that part of the challenge of this reporting value chain is the sort of diversity of needs and perspectives across it. So thank you for all of that. Yeah, Fran, I want to turn to you. And I mean, you have a unique view, both as sort of a field building organization, as well as somebody who sits quite close to a lot of policy discussions. I'm curious how you see this from your vantage, and in particular, any comments you have about the way this conversation looks sitting alongside some of the regulatory trends you're following.
Yeah, well, first, thanks for having me here. Thanks to BlueMark for the research, and those who are listening in, I encourage you to take a read. It's super interesting. I wanted to start with something that, Sarah, you and I talked about, that I developed in 2013 for my first class that I taught on impact investing, because I felt like the students were really struggling, and I was really struggling, frankly, to understand. You talked about the value chain, like the impact value chain, and what are the functions and elements required in order to professionalize and scale this practice with the ultimate goal of flowing more capital for impact. And I developed like an admittedly horrible acronym that doesn't have any vowels, so it's really hard to say. But it was MRVA, MMRRVA, and I still stand by it for the most part. It stands for metrics, measurement, reporting, rating, verification, and audit. These are the functions that allow financial flows to occur, to have truth and faith and understanding and comparability of data. And not that the impact field needs to approximate that kind of level of precision, to your early point, Sarah, but I do think it's really important to understand that all of these functions are required. And while we have had and seen the wide proliferation of standards, impact standards, and more recently, the convergence around and standards harmonization, this question around measurement and reporting is in a state of becoming, and across asset classes globally. And ratings are to come. We already have some ESG rating instruments and entities, and will require verification and audit over time. Some of those functions are the kind of bread and butter of BlueMark itself. Specifically on the regulation, but I just still find MRVA very helpful in trying to think about, to situate different conversations in that impact value chain. So right now there's a lot of activity around ESG standards harmonization and the regulation of those standards. And while ESG and deep impact, which is what we are talking about today, aren't necessarily the same, they can be related. And we also think that what we're seeing is the call for impact transparency and accountability will have repercussions across asset classes globally, whether private funds are regulated or not. We think that there's some regulation coming for private funds, and the call for transparency cannot be, the demand for transparency and accountability can't be rolled back. We're in an unprecedented regulatory moment right now with the SEC, the International Sustainability Standards Boards of the IFRS Foundation, hitting you with a lot of acronyms now, and EFRAG, which is a working group around sustainability disclosure for the EU. They will all be hosting concurrent public consultation to solicit our feedback, market feedback on proposals and disclosure drafts, which will influence the future of impact reporting. So we think that this is a very important opportunity to advocate for this kind of disclosure, advocate for this regulation, but also to lift up how each process can be mutually reinforcing and contribute to more transparent, harmonized, decision useful information to guide the deployment of impact capital. I should note that the SEC and the ISSB will bear solely on corporate disclosure, while the EU regulations do and will require disclosure from asset owners and asset managers. So fund managers that are domiciled in Europe and or gather assets in Europe will need to disclose. And we hope that those disclosure requirements could serve as a tide that lifts all boats and to really to do just that. I think that American domiciled funds that raise European capital will need to disclose in that regard, and that will set a bar. And then finally, to just say that there's a lot of conversation right now about disclosure, and that we believe is the essential building block upon which a more equitable and accountable system can be built worldwide, but it's really just the first step. And the next step, the next frontier is really ascertaining, assuring, and comparing impact reporting and impact performance. And that's why we think that the research report is so important and timely.
Thanks, Fran. There's a lot there. And I mean, it is an interesting moment with all of these standards being put out for consultation, and for this sort of, market, maybe bottoms up market view of what good reporting is to be maybe an input to some of that work. I guess to pivot from that to just sort of getting some practitioner views on the feasibility of these kind of key elements or checklist of ideas. Elizabeth, can I ask you to talk a little bit about, having kind of looked through these concepts, how feasible or how many of the elements that are articulated in the Raising the Bar report are things you're including in your reports to LPs today?
Yeah, sure. I mean, I was happy to see, at least in my self-grading, that most of these aspects were reflected in some way in our reporting. I think there's one in particular that really resonates with me for a few reasons that I'll highlight, which is the relevant metrics one. And this resonates for a couple of reasons that I'll mention. One is that, we're investing across 4 different themes in the global impact strategy. But even within the same theme, like climate action, we'll have companies with completely different ways of contributing solutions to that challenge. And it would, make sense to then measure those in different ways as well. So in fact, across the 15 companies that we're invested in today, I think we're measuring the latest count approximately 40 different SDG linked metrics, so that we can really get at what's relevant for each particular company and its solution and in its marketplace. That does then lead, as the report you mentioned, challenges around data aggregation. But we really think most important is focusing on what is the impact that the company is having, again, on its relevant stakeholders and in its marketplace. The other reason that one resonates with me is, and I say this often, is there have been a lot of really smart people working for a lot of years to figure out how to measure impact and ESG performance. And given that, there was really no reason for us to create yet another framework or methodology for how to measure impact. So in every case possible, we are identifying existing frameworks for reporting either impact or ESG performance. We do consider those very different. And then cross-referencing those frameworks that we used for those metrics in our reporting to our fund investors. And we think that transparency, as well as linking to existing frameworks, is a really important part of our approach. Now, as the report mentioned, in some cases, there may not be existing or tested metrics for specific impacts that we know our companies are having. And in those cases, we spend time with subject matter experts coming up with what we think are reasonable, appropriate, and complete ways of measuring that impact over time as well. So I would say that that's the one that really resonates with me. I think there are a few challenges, sprinkled throughout here. I think the one around relative performance results will always be, I think, a work in progress for many of us. And I was happy to see that the report didn't overemphasize the use of external benchmarks, because oftentimes those don't exist. And then if you consider the 40 or so KPIs that we're looking at, we're certainly not going to find external benchmarks for all of those. So I appreciate the acknowledgement of that in the report. And then I think, the rest of it is really, a work in progress for many of us as we figure out how do we become more transparent on things like risks and challenges, which we started doing just recently ourselves.
That's really great to hear the self-grading, and I like all those points about relevancy make a lot of sense to me. How about you, Tammy? I know you're in the middle of preparing a report. So as you look at that list of elements, are there things that you're feeling more or less confident you'll be able to include this time?
Yeah, I definitely identify with Elizabeth's point on self-grading. It's kind of a checklist to go through to see what we're doing and what we can improve on. So on what we incorporate, we've always been big proponents of sharing our strategy and our objectives and methodologies and our approach in detail and with a lot of transparency. Our reports, the way that we've kind of approached it is that they've essentially been our white papers. This has been a platform where we can share our philosophy, and it's a way to help our stakeholders to understand the evolution in our impact goals and also our impact management approach. So that's a place where we've been very detailed on over the years. We've also been sharing relative performance results and relevant metrics over time. So for example, we've shared key fund level metrics reflecting performance over the last decade, with metrics such as greenhouse gas emissions, jobs, proportion of female managers. But foremost, I would highlight that we've been big proponents of third-party benchmarking since the early days. So it's about, for us, it's also been about benchmarking. So we were a GEARS pioneer fund, the Global Impact Investment Rating System, in 2012. So we actually implemented GEARS assessments for our investees as well as for the fund. And that was something that we used then as a tool to benchmark the portfolio, to benchmark the performance of our portfolio and of ourselves. So that was a tool that we did then. And admittedly, we're kind of searching more and more for, since GEARS shut down, we've been searching for better ways to benchmark ourselves and the performance of our investees. What to incorporate further, I'll say that with an asterisk, and I'll share why. So I'll touch on integrated stakeholder perspectives. In our impact rating tool, we clearly identify the alignment of the affected stakeholders who we aim to target. In our context, it's low and middle income communities and growth markets, but the more challenging side and the proactive part is the stakeholder feedback. And I'm sure that'll resonate with others. So from our perspective, it doesn't always make sense for an investee to have to implement outcome surveys or narrative stories on an annual basis. And I'll give you two examples. We built a healthcare facility, and that healthcare facility has a CRM collecting patient feedback and satisfaction. No problem. We can get great outcomes level data on an annual basis. Wonderful. Can include that in our impact reports. Other investees, we built a water platform that's building a large scale water infrastructure in rural areas of India. There, it doesn't make sense to gather this kind of feedback on an annual basis. It makes more sense to do it in critical phases of the project. So baseline, post-construction, defined period post-completion, that's when we want to be doing that. So there's some points in time where it makes more sense to gather stakeholder feedback on some of our companies than on others. The final point that I would talk about is risk. So if we're always talking about in finance about risk reward, it's fundamental to impact. And that's been our perspective. So risk reward and impact as well. So part of our, and also specifically a vital part of our investment strategy is investing in greenfields. So we build businesses from the ground up. And in light of that fact, our strategy is often future looking. So it's benchmarking and making estimations on what the impact is going to be. And we see from my perspective, that's where risk is increasingly important. So we've actually also added impact risk as a key dimension into our impact rating tool, so we can regularly draw focus to observed areas of failures and trade-offs and improvements that need to be done. And we want to actually be very communicative about that with our LPs, because it's a budding business going from a business plan to a fully operational business.
I mean, I'm having a hard time synthesizing all that. So I think I'm just going to say there was a ton of insight in that, from the way you think about stakeholders to risk to your previous use of gears for benchmarking. Thank you. Bhavika, I'm going to ask you a couple of questions because we just got an audience question asking to build in a little bit on the comment you made earlier on regional differences, and maybe to share a little bit about the kind of what that looks like and the way the reports you receive vary. But I'd also ask, I mean, you shared a few minutes ago that you're trying to be flexible with managers, that you work up front to set expectations. And I'd love to hear kind of how well that works, where things fall down, and any common pitfalls that happen when you're trying to, that you might advise the managers listening to this call to think about as they try to prepare reports for stakeholders like you.
Yeah. So in terms of regional differences, and I think the question is regarding GPs and regional differences among GPs, we do see, you know, certain European GPs and certain Australian GPs being a little bit ahead of the curve in terms of reporting. In general, the US being a little bit behind, but I would also note that we see differences by strategy. So we found the venture industry to be generally less, it's harder for them. I think there's, you know, it's harder at that early stage of some of what you're describing, Tamar, to measure and report certain types of impacts. We've seen the infrastructure industry as on the opposite end of the spectrum being a little bit ahead of the curve, because these are risks that they've considered throughout as investment risks, right? Climate has been a real risk for long dated infra assets. And so they've been thinking about it for quite some time. So, and stakeholder rights and risks have been really real things for long dated infra assets. So I think we're seeing regional differences, but also strategy differences among managers and where they are in their thinking around it. And that's where, you know, we've been spending a lot of time with our growth and venture managers thinking about how do you move ahead on the curve, because we know that the space where you sit is not as experienced in reporting and thinking about impact. The other thing that I would note, and I would agree with Elizabeth, that benchmarking is difficult because you're trying to figure out what to benchmark. And, you know, we've looked at, you know, like how do we think about different types of benchmarks? I think it's hard because you're dealing with a wide range of different types of strategies and managers and impacts. I think one of the things we want to see is that time series data, because if we believe that we're investing for impact, then we want to see a term that I know a lot of people have used. I know, Elizabeth, your team has used, is collinearity, meaning like as you're investing, you're achieving greater impact. Now, there may be points in any company's evolution where both financial performance or impact performance can vary, but we want to see that time series so that we can see, are our dollars actually having greater impact? And I think that's where there's sort of the benchmarking across the industry, but there's also the benchmarking within like a manager and having consistency across their portfolio and reporting to us the same depth. I can take Tamar's point around maybe annual isn't the right level for every project. And I think that's where that collinearity really will make things apparent, that there are phases maybe in a project or a growth of a company where that impact will take step change function movements. But yeah, I would say that it's not an easy thing for anyone. We're trying to be engaged as an investor. We understand the challenge that GPs are facing. We're trying to do our best to have the conversations up front, set expectations, and then be flexible in how we receive the information so that it doesn't always have to be, so that it's consistent, but that it doesn't have to become a big undertaking for all different size and types of managers. But we can appreciate that it's a challenge and a developing area all around.
Yeah, I'm really struck by your appetite to engage and work with managers on these dynamics. Well, I want to leave time for audience questions, but I do want to ask you all if I could, and I'll start with you, Fran, to just reflect on moving the market forward. And I mean, I think this conversation, as you guys have all noted and are gracious enough to contribute to, is an important part of how we move things forward. But I am curious, Fran, as you kind of sit in your seat with the bird's eye view you have, what are some of the key steps you saw in the pathways we laid out, or just in your own work funding across the Tipping Point Fund as is critical to helping impact reporting be more useful. And you can go back to Merva if you want to.
The Greek goddess of impact. um, so yeah, I do. We do a lot of work in public policy and think of that as a catalyzing factor. So some of these regulatory moments are ones that I think will trickle down or trickle down to from the public markets to the private markets, and perhaps trickle over across the pond from Europe to the US. Excuse me. We did on the Tipping Point Fund side an RFP on data metrics and measurement at the fourth quarter of last year. And we had a kind of theory behind it in terms of how we would ideally like the field to unfold. And we focused on a couple of different areas. And I feel like the work that you do at BlueMark on the report in particular touches on a few of them. One, we've talked about a bunch of standards harmonization. The second is standards adoption. The third is verification and audit. And I think that impact performance reporting, in a way cuts across those first three. We also looked at the materiality of impact factors and the future of materiality, and then data infrastructure. And I think that the findings in this report really bear on all of those. We are keeping our eye on a couple different things. One is, as it relates to impact reporting, one is how can these findings be a learning and capacity building opportunity, not just for GPs, but also LPs. So how can LPs, and I think, this cohort of 6 or 7 LPs that will be working with you or modeling good behavior in coming around a table, adjusting their expectations and supporting GPs and producing quality, verifiable impact reports that meet their investor needs, but to Elizabeth's opening point, a range of audiences and stakeholders. I think it's an opportunity for private asset class GPs and LPs to send a signal to the rest of the market and the pub capital markets about what a higher bar for impact performance, higher bar for impact, but also higher impact performance reporting looks like. So those are some initial thoughts about how we see, or kind of a call to the field on a going forward basis around the importance of setting standards for impact reporting within an admittedly kind of heterogeneous deployment of capital, to Tammy's point, very heterogeneous types of investments.
That's pretty motivating, Fran. Thank you for that. I'm going to turn to an audience question, and then maybe whoever answers also ask if you want to comment on the pathways too. But I think maybe Elizabeth, this one could be directed at you, although Bhavika or Tammy, if you want to answer, great. But the question here is, investors are really comfortable with financial metrics like IRR to evaluate a fund's performance. Are you guys seeing in your work any good examples of an environmental rate of return or a social rate of return that people are using consistently to help make impact metrics more translatable or set thresholds?
Yeah, I mean, I would love to hear Bhavika and Fran respond to that, given where they sit in the marketplace. It's, another term for that being sort of impact monetization, and boiling down impact into sort of monetary terms is not a direction that we've gone, partly for the reasons I mentioned before, which is that we really want to make sure we're measuring the direct impact that a company is having on its marketplace and its particular stakeholders. And our view so far, and I'll speak personally, is that the impact monetization frameworks do then boil down very complex topics into a single threshold number, which is certainly understand the desire to do that, but also think it really washes down some of the really important complex aspects of impact as well. So I think we're continuing to follow that and understand how people are doing it over time, but it's not an approach that we've taken to date. But would love to hear what Bhavika and Fran and of course Tammy say as well.
Yeah, I think we've not seen it too much, as Elizabeth alluded to. We've seen, you know, one or two groups doing exactly what she describes, kind of an impact money multiple kind of metric at entry. We've seen certain groups on the environmental side setting science-based targets, which is interesting to see as well. I think, you know, given that we as a space are still far from having a single impact metric like profit, like we have on the financial side, I think it's difficult to have a single IRR because we don't even have a single metric, whether it's emissions or emissions avoided, or, you know, stakeholders impacted or diversity. That we have so many different metrics that to have an IRR, I think, is difficult at this stage. I think we're all in the interest of, it's in the interest of all of us to try and narrow down the metrics to be a consistent set of metrics, have a consistent way of measuring and reporting those metrics. And over time, I would love to see that collinearity that I described. So it's the scale of impact increasing with the scale of investment, increasing with the scale of your business. But I do think we're pretty far off as a space from having an impact IRR.
Fran, I don't know if you want to add anything.
Yeah, this is such an interesting question. I do think, as Bafrika said, that there have been efforts to monetize impact and to look at things in a very quantitative way. I always feel like the monetization of impact outcomes feels like it's rife with moral hazard, because then you are making, it's reductive and you're also making choices. So like an example is we would never talk about a cap and trade system for employees. So like trading rights to pollute, you would never trade rights to you know, be more or less supportive of your employees. So I think the S, and there was another question in the Q&A around the S and ESG, I think that the S in particular really defies quantification. That said, you know, I go back to Jed Emerson's run at SROI, Social Return on Investment, when he was working at the Roberts Enterprise Development Fund. And when was that? That was like in the mid-90s, where he tried to look at, and I think it can work when you're looking at very specific homogeneous outcomes. So there they were looking at putting at-risk folks into good jobs. And so he could calculate the toll on the safety net avoided by doing so. You know, there was a nuanced aspect of that question about what is the weighted average cost of capital. And I never quite could get Jed to tell me, is the WACC more or less than the prevailing, you know, weighted average cost of capital? Like, how would you, I think it's interesting just to think about that. So I think that there are ways, but like Tammy, for your portfolio, it is so heterogeneous. I don't see how you could get at it. So I think it's like Sarah said, you know, it's an art and practice. It's art, excuse me, art and science.
Yeah, I mean, for us, it's normalization is so tricky in a way that if you try to assess what is 100, how much of if $100 is invested in a renewable energy company, then sure, it's probably pretty easy to assess how many megawatts or how many greenhouse gas emissions are being mitigated. But then to add into that context the increase in access to energy and trying to compare between companies that are providing energy in the UK as opposed to Burundi, there's just so much context around that makes it very challenging.
Well, this last part of our conversation really drives home for me that I think we may never achieve perfect harmonization of impact reports, but that doesn't mean we shouldn't try to get better. And so I'm, in the interest of time, I'd like to ask each of you to offer kind of a final comment on something your organization is prepared to do or lead on to help strengthen the quality of impact reports. And Tammy, can I start with you?
Sure, happy to. So for us, it's, I guess, two things. One, it's really, what we want to do is to add into our impact reports, especially in our public facing reports. What are the reference frameworks? What are the referenced frameworks and the metrics so that they can be verifiably compared, and so that it's useful for other stakeholders as well. And then I guess not necessarily to the large fund managers, but maybe more towards family offices and LPs like that is, it's also, well, I guess it's to both. It's providing numbers and context. So not working with vanity metrics, and it's a lesson for ourselves included. It's making sure that we are connecting the output and outcome level metrics as proof points to our theory of change, and really making sure that how are we linking that? Is it really, and assessing that regularly, making sure that, you know, we're providing the narrative and the context of why we're measuring it and what is it actually achieving.
Super. Thank you. Elizabeth, can I put you on the spot next?
Sure. Well, you know, KKR in general is always committed to being at the table with the rest of the industry and talking about these challenges and sharing our experiences. So thank you for inviting me on this. I think, you know, beyond KKR more broadly, one of the things I think we collectively need to focus on is data quality and need to figure out a way to really build up the capacity across the entire marketplace around collecting and analyzing data in a way that we all feel confident with. I think part of that means whether it's assurance, auditing, verification, validation, I think they all mean different things, bringing those costs down so that we can effectively actually take a look at those data. And I think that's really out of reach for many small companies and fund managers these days.
Well, thank you for that, and glad to have you at the table. Bhavika?
Yeah, I mean, I think we sit in a unique position of working across a variety of different private asset classes, so private equity, private debt, real estate, and infra, and working across a lot of different clients globally. And so I think what we can bring uniquely is that viewpoint from all sides. So engage, as I mentioned before, like we're highly engaged with our managers as we invest. I think part of that is we're bringing the views from a wide ranging set of LPs globally that we service, but also that broader viewpoint across private markets of where we see leaders and best practices and how a manager might seek to engage or move in that direction. So I think our value add is engagement both at the industry level as like what we're doing here and having this discussion, but also at the more micro level on a, you know, GP by GP basis. And then also on the flip side with clients to help them understand what's available, what should they expect and prepare them for where the industry is.
Thank you for that. Fran, in our last minute, can I leave you to offer a parting comment?
Sure. First, again, thank you for including me in this conversation, and really enjoyed hearing the practitioners talk about these ideas in action. So just lifting up the work, the great work that you all do. I think well, for one thing, I think that there can be deep impact, and over time will be deep impact in the capital markets and public companies. And so very interested in keeping our eye on that, and what can public companies learn from the deep impact practices and the reporting practices and the analytical practices that you all work on. In terms of where we would like to lead, you know, we'll continue to advocate for companies, asset managers, and investors to move toward transparency, accountability, and equity. We've touched on equity just a little bit around, you know, who sets metrics and who discloses and who gives feedback, but we do think that that's really important, like the bottom-up aspect. But as Elizabeth said, I'll just echo what she said, that data integrity and accuracy are really important to understand and compare impact performance in private markets and public markets. And we feel like verified impact data will create the conditions for standards refinement for industry benchmarks and other critical tools so that capital can be deployed in better ways by LPs and by GPs for deep impact.
Oh, thank you, Fran. Thank you to all of you. I'm so grateful for your insights and all the wisdom you shared today. And thank you to everybody who joined. I look forward to future conversations with all of you. Have a good rest of your day.